Randy from Texas writes in about deferred compensation programs and questions regarding them, 409As in particularly. And here's his question. Hey, Josh, love the channel. Just turning 55 and have a pretty high salary with a bonus. Have a 409A deferred compensation plan. With employment separation, it pays out in a lump sum or over a 5 to 10 year payout. Currently have a pretty significant amount of money in this deferred account. Can you do a video, or have you done one on 401A in a retirement strategy, a 409A in a retirement strategy? Absolutely, Randy. Yeah, Randy. This is a challenge. Deferred compensation is a challenge. So let's talk about how these work first and foremost. And these are non-qualified deferred comp plans. Let's see if I can't make this bigger. I'm telling you, a lot of people think it's to cast me out. I'm just telling you. Look, I'm not saying it's not. If your company offers it in lieu of taking income when you're making good money, that might be beneficial. But I'm telling you, just be careful. So an NQDC, non-qualified deferred comp plan, allows a provider, employee, to earn wages, bonuses, or other compensation in 1 year, but to receive the earnings and defer the income tax on them into a later year. That also coincides with when the employer can take the tax deduction. The employer doesn't get a tax deduction on the salary until they actually pay it. And they're not paying it. You're not paying the tax on it. So the employer doesn't get a tax deduction, if that makes sense. So for them, for the employer and for the employee, it's like no harm, no foul. From a tax perspective, later on down the road, it's a big deal because the employer gets the deduction because they pay it out, and the employee then has to pay tax on it. That's the key consideration. The tax bill is always due, my friends, always due. All right. Doing this provides income to the future, often when they left the workforce, i.e. when they're in a lower tax bracket. That's the idea here. And may reduce the tax payable on the income if the person is a lower tax bracket when it's received. I mean, inherently makes sense. So I'm making, let's just say, $200,000 today. All right, so that's my income, $200,000 today. I leave the workforce and I make nothing later on down the road. So let's just say I have a deferred comp of $50,000 at that point. Well, in this case, that $50,000 is taxed at 10 or 12% tax bracket, as opposed to 22 or 24% at that point. Okay, so that sounds good. I mean, from a theoretical or even a spreadsheet, it says great. They can be qualifying or non-qualifying. The non-qualified type is created by an employer to enable employees to defer comp that they have a legally binding right to receive. All right. Non-qualified is created by an employer to enable employees to defer compensation that they have a legal binding right to receive. There are several types of NCQ and QDCs, which is the 409A plans, is what we're talking about here. The one discussed here is the basic unfunded plan for deferring part of annual compensation. All right. So the tax law requires the plan to meet these conditions. It's got to be in writing. The document specifies at the time an amount is deferred, the amount to be paid, and the payment schedule, and the triggering event that will result in the payment. So those three things: the amount that's being deferred, the amount to be paid in the future, and the payment schedule. There are 6 permissible triggering dates: the fixed date, separation from service, a change in ownership or control of the company. That's a big one right there. In fact, a lot of times when it comes to 401k plans, a change in ownership automatically vests you in the 401k, even if you previously weren't vested. So a lot of times a change in ownership is a good thing on a 401k plan. Disability, death, or an unforeseen emergency. That leaves a lot there, unforeseen emergencies. But for you just saying, I don't want the money today, I want it next year, that's not unforeseen. Other events, such as the need, right here, actually what they say, other events, a change in the financial condition of the company or a heavy tax bill are not permissible triggering events, or tuition. Cannot stress this enough. It's very explicit when you do the deferred comp. You're saying, I'm not taking the money now, I'll take it in the future. I'll take this amount of money in the future, and this is when I'm going to take it. The employee makes an irrevocable election to defer comp before the year in which the compensation is earned. However, a special deferral election applies to commission payments. So, man, I can't tell how many people I talk to on this. Should I do it? Should I do it? Should I do it? And you got, I mean, it's just there's so many questions going on in people's heads, like, should I defer my comp? Should I defer my comp? Should I defer my comp? Because the idea would be that they're making $200,000 now, and they're only going to make $50,000 in the future. But all right, so let's keep talking about this. The plan can also impose conditions such as refraining from competing with the company or providing advisory services after retirement, non-compete, things of that nature. The deferred amount earns a reasonable rate of return determined by the employer at the time that the deferral is made. This can be the rate of return on actual asset indicators, such as the S&P 500. Thus, when distributions are made, they include both the compensation and the earnings, which is pretty cool. It's actually pretty cool. So the couple things, a lot of times with having so many different deferred comps, it's completely up to your plan. What should I put the money into? How do I invest my deferred compensation? I remember working with Fidelity. They're actually pretty helpful in this. It was a company a healthcare company out of Boston. I forgot who it was. And they were using Fidelity as their employer for the deferred comp, and it was confusing as all could be. I remember as a client, me, and we got on the phone with Fidelity. They just walked us through the options. It was very, very helpful. I give much credit to Fidelity. I do want to say I bash on Fidelity relative to Vanguard a lot. When it comes to the more strategic retirement planning, business stuff like that, Fidelity's better. I will say that. 401ks, I'd prefer Fidelity over Vanguard. Fidelity has solo Ks. They have more meat on the bone than Vanguard does when it comes to specific retirement planning for businesses, for sure, deferred comp, that kind of stuff. Fidelity's just better, no other way around that. And one of the reasons because they have more money to throw at that line of work that Vanguard does. All right, violating the stringent conditions in the law triggers harsh results, all of which becomes immediately taxable. What's more, there's a 20% penalty plus interest charge on the amount. All right. Supplemental executive retirement plan, SERPs. A lot of times people use life insurance. I'm not an expert on that by any stretch of the imagination. You email me if you want. I just don't know. Teacher salaries are non-qualified compensation plans that meet the requirements of 409A. If the teacher earns $54,000 a year and works from August 2016 to May 2017, she earns $5,400 a month. If she is paid only for the month she worked, she is paid $5,400 a month for 10 months. If, however, she paid over a 12-month period, she earns $4,500 a month. That makes sense. In this example, the salary with a 10-month salary, the teacher earns $27,000 in 2016 and $27,000 in 2017. With a 12-month salary, she earns $22,000 in 2016 and $30,000 in 2017. But based on the hours actually worked, if she's paid in a 12-month salary, $4,500 of work conducted in 2016 is paid in 2016. You just have to dive into that a little bit deeper. But I want to go down to here. Advantage for employees. Unlimited savings and tax benefit. Interesting. The IRS imposes strict limitations on the amount of money you can contribute to a qualified plan, like a 401k. Deferred comps have no mandated limits, although employers may specify a contribution limit based on your compensation. I remember the ones I deal with this healthcare company, that was the case. I think it was up to 25% if memory serves. If you're a highly compensated employee, you can maximize your contributions to your 401k and then continue to build your retirement through a non-qualified deferred comp plan. The ability to defer any amount of compensation also reduces your annual taxable income. This can, in turn, put you in a lower tax bracket, further decreasing your tax liability each year. But deferred comp is still subject to FICA taxes in the years earned. So you're not getting around the 7.65. It's just not happening. But you're not paying any income tax. Investment options. Many non-qualified deferred plans often offer investment options similar to 401k plans. They aren't just fancy deposit accounts for high rollers. Instead, they allow you to grow your wealth over time. However, you can invest on a larger scale because your contributions are unlimited, increasing the potential for bigger gains. But here's a disadvantage. You got to stress this. Unlike a 401k, you must schedule distributions from the plan in advance. Rather than being able to withdraw funds at will after retirement, you must choose a distribution date at some time in the future. You must take distributions on the designated date regardless of whether you need the funds or how the market is doing. Down market or you don't need the money, doesn't matter. This means your taxable income for the year is increased, and the timing of distribution may mean that the assets in your investment portfolio are liquidated at a loss. The non-qualified deferred comp plan can allow for a subsequent deferral or a change in election, i.e. to receive deferred compensation at age 70 rather than 65, only under certain conditions. I don't know why you do this, but It does allow you to do that. This requires that a subsequent election be made at least 12 months before the start date of the payment was originally scheduled, that the subsequent election delays the payment date for at least 5 years, that the subsequent election delays the payment date for 5 years, and that the election is not effective until at least after 12 months after it's made. No early withdrawal. Though it is discouraged, employees who contribute to 401k plans are legally allowed to withdraw the funds at any time. Non-qualified plans, conversely, have no such provisions. You must withdraw funds according to the distribution schedule and not earlier. Funds contributed to the non-qualified plan are not accessible before the designated distribution date, even if you have an emergency financial need that you cannot meet by other means. And no ERISA protections. If the plan is unfunded, you must rely on the employer's promise to pay in the future according to the distribution schedule. If the employer falls on hard times and must pay off debts, the funds that might have been used to pay your employee distributions can be claimed by creditors. Funded non-qualified deferred comp plans offer more protection for employee contributions, but deferrals are generally taxable in the year they were earned, nullifying tax benefits. So a lot of them are non-qualified deferred comp plans. And you are, there's some kind of a rabbi trust, if that's what it used to. Man, it's been a long time since I studied this on financial planning. Rabbi trust. But anyways, what that simply means is you're deferring money. There's no guarantee you're going to get back. I mean, the company will have to pay it, but if the company goes kaput, you're done. You're going to lose that money. All right. There's another financial risk: the rate of return paid on the deferred comp. An employee may be able to earn a greater return on the after-tax amount without deferral than was paid into the deferral comp plan. All right, so at the end of the day, what's my take on these? By and large, I shy away from them. I do. Now, the reason for that is, let's just say my man Randy here is 55. He's going to start pulling out at 65. He's going to do it for 10 years. So we'll say he has $200,000 in his deferred comp plan, and we'll just, at that time, we'll just say is that $200,000 at 65. He's got 10 years, so he's got to pull the equivalent of $20,000 a year, and then whatever the last amount is in year 10, it could be $40,000, it could be $4,000. We don't know because the market will still fluctuate. The problem is that once 70 hits, right, he's going to have that plus his required distributions on his 401k plan. And all that's going to be his taxes, ordinary income. And I think that gets overlooked a lot with deferred comp plans, because you're not paying tax on this $200 now, but you're also not getting 401k you're not getting 401k deductions either, what you are on your deferred on your 401k plan today. So you're basically pushing off in the future what you could pay in taxes today. And I don't know if that's a good thing. And then in some examples, it makes a sense. Look, I'm making $200,000. I'm going to retire at 60, and that's when I'm going to start taking that $20K a year off my deferred comp. I have no taxable income. I get that. I just haven't seen it happen that much. I haven't. So I would, if I were you, and I don't know your situation at all, I would do whatever I can to get it all out before I start taking required minimum distributions. I mean, if my inclination is avoid Social Security, take your 401k plan, and take your deferred comp while you're deferring Social Security as a way to supplement your income, and also take your 401k out at that same time. Any way you can avoid your Social Security, 401k, and non-qualified any kind of deferred comp, that's 3 sources of taxable income right there. And if you have 401k plans, deferred comp, your Social Security is going to be taxed at 85%. Not 85% tax rate, but 85% of your Social Security will be taxable. And I'd rather not happen. So I'd rather you say, not touching Social Security. So basically, you look at this. You look at your deferred comp as a way to mitigate the need that you take Social Security until you're 70. Does that make sense? So I was getting $30,000 a year in Social Security. I'm only going to get $20,000 a year for deferred comp. I'll take $10,000 a year for my 401k. Fast forward till I'm 70, deferred comp's paid, and then I get $30,000 a year of Social Security with my delayed credits as well, and it'll be much more tax favorable. So that's my thought process. I'm just telling you, I've seen it happen. It hardly ever works out as well. And again, I hate to say it sounds like it never did. That's not true. But most people do it because they're under the guise, again, of deferring income as long as they possibly can. And then they defer income, and now they're paying taxes on 401k distributions. 85% of their Social Security will be subject to tax, plus the taxes on deferred comp as well. And if they just would have structured it differently, say taking deferred comp at 60 to 70, 65 to 70, deferring Social Security till 70, and just very rarely do that. All right, hope this helps. Just be careful on these non-qualified deferred comp plans. And secondly, remember, at the end of the day, it's not your money. If the company goes and having a hard time, your deferred comp money that was literally your income it could be wiped away for sure. I mean, this is factual, my friends. I am a fan of one in the hand is better than two in the bush. And when it comes to deferred comp, one in the hand, even if it costs you 22% taxes, I think is better than two in the bush if it's only going to cost you 10, 12 years in the future. That's my general thing on that. All right, we'll see you next time.